That's it. Since we've covered up to this point the range analysis and the idea of momentum, most people, when they think RSI, think divergence. And now we will now cover divergence, and I postpone divergence till after I've been able to share with you the concepts of momentum, the major categories, namely price, momentum, time, and sentiment, because I want you not to focus when you look at RSI on divergence. Most people get caught up with divergence, and no matter how long they've been using RSI, they know that word divergence is associated with RSI. Well, the word divergence can be associated with any momentum study. It's just another word of saying non-confirmation, which we had talked about before, that price goes up, momentum goes up with it. Price goes down, momentum increases, or volume increases. Excuse me. But most people familiar with RSI look for divergence first. And from what I've shown you so far, you see that I don't. Divergence, yes, is a signal that the RSI shows. But it's just a minor signal. When we get into divergence, we will also be looking at counting the number of periods, whether it's on an hourly chart or a daily chart or a 5-minute chart or whatever. We will be counting the number of periods to identify the higher, more important divergences as opposed to just a minor little divergence. We will see that what we had discussed with momentum highs and momentum lows being the starting point for both bullish and bearish divergences. And there on chart 2-22 you see momentum highs, lows, bull-bear divergence, and number 4, degree of, whether it's a short-term divergence, intermediate type divergence, or longer-term divergence. The signal count and the 2 to 5 period signals where we get really into the specifics of what a divergence is and how to identify the more important divergences. If a divergence is many weeks apart, that doesn't mean as much as it would mean if it were on a daily chart, a lot of divergences showing up at the same time. The other thing about divergence that throws most people off is they feel that divergence signifies the end of a trend. That if a market's been going up and it creates a bearish divergence, that this is the end of the up move. Or if it's going down and it shows a bullish divergence, it signifies the end of the down move. This is not necessarily the case, number one, and you'll see why I use the word detour when we get into the actual construction of divergence patterns and counting signals. In the checklist, which we are consciously and subconsciously building through this basic level, we have a checklist for uptrends, and then we have a checklist for downtrends, our basic checklist. The range analysis that we went through, for the uptrends it would be 80-40. For the downtrends it would be 60-20. And as we get into divergences, we will see that bearish divergence shows up in an uptrend, and bullish divergence shows up in downtrends. But most people approaching RSI look at it the opposite way. They say bearish divergence comes in a downtrend. No. And this is where they get caught. And there's fake outs, and people are blindsided thinking that something's over before it really is. So by focusing on trend, we're going to be looking for certain types of divergences. 223 is a chart that's marked momentum highs and lows. Excuse me. The little stars that I put on, or marks on the RSI chart at the bottom, are points where it was making either a momentum high or a momentum low value in the RSI. When a market makes a new high or makes a new low, momentum high or momentum low, they're going to be the points that we're going to start to count these divergences on. They're going to be the points where we start what we call our signal count. So any chart that has, and I've given you numerous examples here, this 223 is a weekly, 224 is a daily chart, 225 is another weekly on the dollar index. But I want you to look at, look at again where these momentum points come in, either a high or a low, and where the prices are. If you look at 226, left-hand side of the chart at the bottom, you will see the RSI had sold off and started to make a bunch of momentum lows, but they were rising while prices were declining. If you look there in January, February, and March, it had been above 60, making multiple momentum new highs with prices going to new highs. Apply your range rules again. In this case, May and June on that chart at the bottom barely got above 50. We had a little attempt in late March, early April, to where it almost got back up to the 60 level. But each momentum high after that was even below 50. Prices were clearly in a downtrend. Again, applying the range rules, but we're watching these momentum points to see where they are, because we're going to start counting the number of points or periods between a momentum low, where the price makes a low close, the RSI makes a low, and 2, 3, 4, 5, whatever number of periods after that comes a lower low in price with a higher low in RSI, which takes us to chart 227. Basic divergence. If you look at the top chart, you see line A with points 1 and 2. Now use your triangle, look at the bottom, and line those up, those point 1s. You see a low in close, you see a low in RSI at point 1. You have the market rallies, the RSI rallies. The next pullback to where the closing price goes to a lower low at point 2 than it did at point 1. Price went to a new low, okay? But look at the RSI. The RSI failed to go to a new low, a lower low than it was at number 1. So RSI, when it dropped, did not go below the RSI value at point 1. When it had dropped into point 2, it was not lower than it was with the RSI at point 1, but the closing price at point 2 was lower than it was at point 1. So your bar chart is pointing as if the market is going lower because it closed lower. The RSI is saying, we don't believe this. It's not being confirmed by RSI going to a new low. If the RSI had gone to a new low at point 2 on the bottom chart, below where it was at point 1, you would have had what? A lower close and another new momentum low on which to start your divergence, or base your divergence and start your non-confirmation. This is basically what divergence is. Divergence is when a market makes a lower low and the momentum indicator, in this case the RSI, fails to confirm the move to new lows by price because it does not go to a new low itself. Okay? The basis of line A on your bar chart and line B. It's more than, this is a weekly chart, but it's more than what our optimal time frame would be of 2 to 5 periods. But what you're taking note of is the fact that you're seeing a market make lows without being confirmed by new lows in momentum. You then get a rally up to line B, 0.1 on your RSI chart, where the RSI had gotten above 60. A little sell-off in price, and a higher high at 0.2 on your bar chart than it was at 0.1 on the bar chart, the closes. Now you're looking at the closes, not necessarily the high, because you're calculating the RSI on the close price. You can calculate it on the high, you can calculate it on the low, but you're basically going to see the same type of patterns. But I use the close because of what I had mentioned before about the importance of the closing price and how people will make a decision based on how the market is either up or down in relation to the price that they bought or sell. But at 0.1 on your price chart at the top, the market had closed up, sold off for a couple days, and then went to a higher high and closed at 0.2. But on your lower chart, you look along line B, you made a high in RSI at 0.1, but a lower high at 0.2. That's the bearish divergence. Now most people, when they look at charts for divergence, they would look at that line A on the top chart and see the lower close and say the market is breaking down because price is going to a new low. It's breaking the old support level. We should sell. This is where I said people sell low and buy high. They figure it's a breakout to the downside. But if you look at the RSI, it's not going. Remember the charts we went through at the range where it started to make higher bottoms even though prices were going lower? We started to get intermediate type divergence. This, I think, was 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, about 16 days apart, 16 or 17 days apart. So it'd be considered more of an intermediate type divergence, intermediate to longer term. We want to try and focus in on the number of periods between 0.1 on the bottom chart and 0.2. If it's 2, 3, 4, or 5 periods, it's going to be more important than if it's outside that number of periods. If it's greater than 5, in this case 16 or 17 weeks apart. The one at the top, the second divergence along line B is 1, 2, 3, 4, 5, 6, 7, 8, 9 periods apart. Okay, so the shorter the time frame. Still more of an intermediate type divergence. As long as I've followed RSI, I've found the divergences which are most significant are those which fall in the 2 to 5 period time frame. Ones that are outside 5 periods, where it may be 6, 8, 10 periods apart, will have an impact on what prices will do, but are not as important as the 2 to 5 period signal. If you notice also on the bottom of the bottom chart, you have a divergence along line B, a bearish divergence, or what some people call a sell divergence. But when the market sells off from that divergence, put a little star in there because look where the market sold off to, the 40 level. So again, we've got that range rule of watching to see if there's support at 40. In the checklist we're building, 80-40 is an uptrend, is our range rule for up. Bearish divergence is also on that list. And I've written down all 5 for you on another page, but you might want to make note of it here because this lower chart, line B, you see a bearish divergence, and you also see after the bearish divergence of line B, the market had sold off to the 40 level. The 80-40 range with bearish divergence, 2 key points for an uptrend. When the market rallied from that little star, it went back up through the 60 level, and if you take your ruler or your triangle, and you extend that line B all the way across, you will see where it negates that divergence. It breaks that line that was set up with points 1 and 2 along line B at the bottom chart. If you extended it all the way across, the RSI rallied up and broke through that line, negating that divergence. Also, at the time, breaking above the 60 level. So bearish divergence shows up in the downtrends, shows up in your uptrends, and your range rule is also kicking in. We have some examples of how we'll look at support levels on price based on these points, but I just want to go through examples of bull and bear divergence because most people are in a hurry. Yes, if you had bought on the bottom chart with the divergence of line A, you say, okay, there's a bullish divergence that worked. But the bullish divergence, this is on a weekly chart. Remember I said earlier about if you take divergence, you see divergence on a weekly chart, that's your longer term time frame if you're a day trader, if you're a position trader. When you see line A, where you made a lower close, and you see a bullish divergence, look at your daily charts. This is a weekly. Drop it into a daily chart. See if the daily chart is also showing a divergence. Now the divergence is only for the idea of the market getting a little overextended in one direction, oversold. Okay? It's a little oversold, you should get a bounce. Instead of the word divergence, I use the word detour, and we will see when we get into some daily charts that you can get multiple divergences. And you see this line here we just drew, that it came back to the 40 level and turned up and broke it. If you extend that line A all the way across at the bottom, you'll see where it pretty much came back to that as a longer term support line. So you should learn to teach yourself to extend your trend lines all the way across the page on your RSI charts, because as we had talked about before, support and resistance trend lines, when they're broken, become the inverse. If a line is support, when it breaks it, it'll usually rally back to it and become resistance. If it is resistance, as it was here, this line B at the bottom, when it breaks it, usually comes back to it. Was a resistance line, becomes a support, which is why we spend so much time on that basic of trend or of price, momentum, time, and sentiment. If you look at examples starting on 228, and you may, before we go on, you may be thinking about the fact that with divergence, why I made the statement about 2 to 5 periods. We will see it when we get into the signal counts, but it's just been my experience, and this comes from years and years and years of doing charts. This 2 to 5 is the most optimal time frame that I have seen, I think because of the fact, maybe a couple reasons. One, there are 5 trading days in a week. A lot of people are trading weekly. If you are trading a market, you might be quicker to take profits and cut your losses because you're out to try and maximize your return. But a lot of times, being a broker, and I saw this when I was in the brokerage business, if you put in a trade on the first of the month, and by the end of the week you had a nice profit, a lot of times the client would say, let's take a profit before it gets away from us. Or if the trade moved against you a little bit, and then in the middle of the next week he said, well, let's break even or whatever, but you might see somebody trade the market 3 or 4 times during the month. With 20 trading days in a market per month, on average, I think you're going to see people go in and out at least 2 or 3 times. Position traders, we tend to hold positions longer because we're going to be focused more on trend. The 2 to 5 period has just been, number one, I know why the 2 period is most significant, because if we get a momentum low, we can't get a divergent low like we had there with this chart at the bottom there on 227. That number 1 point is the momentum low. Well, if the next day, say this were not 9 periods apart, the shortest time frame you can get is 2 periods, because you have to make a momentum low, and then a rally, and then close at a lower low to create a divergence. If it were to rally for 2 days, and we will get into the types of signals, whether it's a simple signal or an extended signal, but in this case here it was 9, I think that one was when it was 17 periods apart. The 2 to 5, the signals that I have found that fall into the range of 3 period, 2, 3, 4, 5 periods, have always seemed to be stronger signals. I will put more emphasis on a 2 to 5 period. I have clients that I talk to that follow markets maybe that I don't even follow, and they'll call and say there's a 2 to 5 showing on this market. But if it gets out to 6 or 7 or 8 or 10 days apart, then we say, well, it's probably just a short-term low and you're going to get a bounce. Statistically, running technical studies and optimizations and whatever, back in 78 and 79, I didn't start using a computer till 1986. So for 8 years, I was doing it basically with a calculator and paper and pencil. I wasn't even doing statistical studies other than calculating the RSI and plotting them daily. And just by seeing it over and over and over again, seeing a 2-period signal in the market moving and seeing it extend out to 6 or 7 or 8 periods. I cannot give you statistical evidence why the 2 to 5 period works, other than to say that it has been the one that has been most consistent and most reliable. It's the one that I will sit back and wait for. If I see a divergence that's 2 to 5 period, then I'll be more apt to say yes with a high degree of confidence. But if we're just going to get a signal where from momentum low to a point where it makes a lower close and then starts to move up, and it's 16 or 17 days in the case of the daily charts I'm looking at, then I won't put a lot of emphasis in it until maybe we come down and create another 2 to 5. Or if we come down and we go lower in RSI and are higher in price and we create these positive reversal patterns, which we'll get to. But just tuck that away, that the 2 to 5, and when you start checking your charts at home and you count the number of periods between the momentum low and where the lower close is to create a bullish divergence, or where the higher close is to create a bearish divergence, that you're going to see that the stronger signals are going to come from the time period of the 2 to 5. 228, it's just a weekly chart with some more divergences pointed out. 229, a dollar index weekly. Now we'll get into the 2 to 5 and counting like a 2-period signal first with chart 230. As we said before here on number 1 under divergence and signal count, you've got to start it with a momentum high or a momentum low in the RSI. A new RSI low or a new RSI high. That new momentum low or high we will call the X point as a starting value or a name. Again, bullish or bearish divergence, degree of, short term in the signal count. This is set up with a bar chart. We're going to look at just a simple 2-period signal. Upper left-hand column, chart A. You'll see the market, this just has the closes and the range for the day. But chart A is your bar chart. Chart B is the RSI chart with price values put on it, the closing price. And chart C would label it with X count or X point as your starting point, your RSI low. So you start with your bar chart and you see the market closed lower than it did the day before. Chart B, you see the value of the close would say 100. Chart C shows the X point. It's a new momentum low, new closing price low. The following day, if you look at the middle chart, we rallied from a closing value of 100 where the RSI had made a low, rallied up to 104 on a close. Closing price had closed higher in your top chart A. So that's one period later. The day after that, the market sold off again. The close on the chart B, the price was 104 on period 1 or day 1. We'll just say day for right now. You have your X day. The following day you rally to the 104, from 100 up to 104. And the day after that you sell off back to 99. Your closing price of 99 is less than the 100. It's 2 periods or 2 days after the X day. So this is the shortest time period you could have for divergence. You have to have a starting point, which is your X point. Then you see the rally from X up to 1. The price go from 100 up to 104. And then a sell-off where the price drops, RSI drops, but RSI drops not to a low below where it was at the 100 value or the X point. So we'll now just look at it in terms of the lower chart C. You have an X point or a starting point, a rally, and then a pullback. 2.2 was not below in RSI. See, I just drew the RSI patterns in for both B and C, but B I labeled with prices, and C I labeled with the signal count. Your bar chart I put in so that you can see you had your X point, X day. The following day it closed up with the hash mark on the right-hand side being higher than it was at X. And on day 2, the hash mark was back down because the market had closed down. Okay? This chart B, it's the RSI drawn in, but instead of putting a signal count, I put the closes in so that you can see that the RSI was starting to go up, was not dropping to new lows. It had made a higher low. And chart C shows you X12. But you can see when you draw the RSI in and you put prices on the RSI, what the closes were, you see that 99 was less than it was at 100. Price had gone to new closing low, but the RSI was higher. Basic 2-period bullish divergence pattern. Momentum low at point X. Look at chart C now. Momentum low X, a rally day, day 1, and then a pullback on the day 2. The RSI was starting to show somewhat of an upward slant to it because the RSI was not dropping to a new low, even though prices were. I drew the same RSI on panel B, but this time instead of labeling X12, I put the prices in so that you can see that it did close at a lower close, but the RSI did not go. Now when we look at the bearish divergence side in the 2-period signal, look at D, E, and F. Bar chart at the top, RSI patterns in E and F with the signal count marked in F, X being your momentum high, then down to number 1, and a rally back to number 2. Now if we drew the same RSI and put the closes on it, you look at panel B, E, the high that was made in the RSI, the market was at 100. The market sold off a little bit to 97, and then there was a rally up to a price of 103, but the RSI did not go to a new high like price did. This concept of divergence, as I said, shows up in many different types of technical work where people are using divergence to confirm or not confirm moves to new highs or new low by price. But using the signal count, the stronger signals will be usually when the periods between your X point, look at lower left, panel C, between your X point and then here, in this case, a 2-period signal, and then panel F, a 2-period bearish signal. If you see it to where it had rallied from X maybe up for 2 days and then down for a day, then it would be 3 periods. So you have a momentum low followed, a momentum low in the first panel C, left-hand side, momentum low X, and then you count the number of periods or days or weeks or hours from the momentum low until you see the market go to a lower price close, but the RSI not go to a lower close, a lower value. The opposite for panel F, to where you see the momentum high at point X, and then the market sell off and come back. It could be 2, 3, 4 days later, where the market goes to a higher close, but the RSI does not go to a higher close. So it's a simple pattern for the 2 period. The charts we had looked at previously on that bond where we had both the bull and bear, they were 17 periods apart, 9 periods apart. They were well outside this 2 period. This is the optimal signal. But the signals can fall in the 2, 3, 4, and 5 period signal. And they're the ones which I have found over and over have been the most reliable. Okay? As I said before, you can see markets which create multiple divergences. When a market is in a downtrend, you might get one of these like panel B and C, where you get the little 2-period signal and the market rallies up. But remember, we had talked about price and momentum, and the momentum is still below the 0, saying that the basic trend is still down. Well, you'll get multiple bullish divergences. And when we see what negative reversals are, you'll see that the market still stays down, because that's on our trend analysis checklist. But we have bullish divergence and bearish divergence. It does show up. A lot of people trade off of it and they get faked out by it. And I'll show you why. If you look at your next page, 231, what I did here is I took the start at the top of the chart, bear divergences. You have the 2-period signal, panel A, which is X down and then back up to 2. So you say, all right, 2-period bear divergence. Panel B is what the closing price would look at if you track just, remember we did the line just on close? If you looked at the line just on close, you would see an X point equivalent to the X point that the momentum high made. Then you would see the market drop down to where the line would turn down, and then it would turn back up and go to a higher close on a line on close. So this is a line on close. In panel B, this is the RSI value. Takes out that bar chart, which shows all that crazy activity. But what you see on the close price is the market closed higher at 2 than it was at X on panel B, but the RSI was lower at 2 than it was at X. The inverse for the bull divergences. Panel C, you see an X point where you made a momentum low, a rally to point 1, a pullback to point 2. Now if you were tracking and plotting the line on close, you would see the coincident X point where the momentum low was made in RSI, a rally, and a lower low in close. Okay? But I put these in to give you an idea. It's almost like if you were to flip it over and lay B over on top of A, it's like a mirror image. And you lay C on top of D. Just fold the chart halfway. But the X points and the signal counts and in A and the X point and the counts in B will give you an idea of where the closing price is in relation to whether or not divergence is showing. And same thing for the bull divergence. You look at 232, this is just drawing the line. This is a bearish divergence case. This is drawing the line where, all right, let's just look at the RSI chart first. At the top, you had an X point where the RSI made a new momentum high. And then I counted them 1, 2, 3 periods later, it made a lower high. The RSI did, lower value. Look at your line on close at the bottom where your X point is, and the market sold off and was about on day 1, day 2 was kind of unchanged up a little bit, but at point 3 the price close was higher. Well, up here on your RSI chart, X 1, 2, 3 is 3 periods apart. Price was, on the bottom chart, the price was higher at 3 than it was at X, but on the top chart, the value of the RSI at 3 was lower than X, a bearish divergence. And I said bearish divergence comes in uptrends, and you can get multiple divergences. You can get a divergence followed by a divergence followed by a divergence, and the market continues to go to new highs, and you're saying, but the market is oversold, and it's showing bearish divergence, and since it's showing bearish divergence, it should go down. No. Bearish divergence is usually bullish. Okay? Most people practice and think that bearish divergence is bearish. No, bearish divergence is usually bullish. It sounds like a contradiction in terms, but it comes in the uptrend. You see bearish divergence in uptrends. In this example here, you see 3, the lower chart, the close was higher at 3 than it was at X. The RSI was not. The market sold off, lower chart, from 3 to 4, and then went to another new high and close because 5 was greater than 3. The price there, because this is, I think, a gold chart, the closing price at 0.5 was higher than it was at 0.3. Look up at the RSI chart. The RSI value at 5 was less than it was at 3, showing you that the market is what? Losing momentum. It's creating bearish divergence, and you're losing momentum, but you're not yet ready to jump all over it unless you want to be super aggressive. After 5, price had sold off, RSI had sold off to 0.6, and then you had another rally attempt in price from 6 up to 7 to where it went to another new high, but RSI was not. So you basically have 2 signals showing up on one chart, 2 divergences. Your top chart, X 1, 2, 3 is a signal. Then it extends out to 5 periods, 4 and 5. Then it extends even further to, from 5 down to 6 up to 7. All the while the price is continuing to go to new highs. Most people sell that X point at 3, or sell the RSI point at 3 and say bearish divergence, it's over. Well, the market continues to go up. If it's over, it should stop. But you get multiple divergences. But look at the divergence along line A with X and 3 and along line B with 5 and 7. It's starting to show up a little lower on the chart. So it's saying on a longer term basis, you're losing momentum. That's on the bearish divergence side. As I said, bearish divergence comes in uptrends. Lock that one away in in your memory because we're going to be using that on our checklist for trend analysis. We will also look at the bull side, which is your next chart, chart 233. So where we've got an example of the RSI chart at the top and a line connecting the closing prices at the bottom. Well, we have an X point in the RSI where it made a new momentum low, top chart, and it rallied for 1, 2 periods, sold off a little bit on period 3, a little more on period 4, went into the 5th period from the X point. Starting X is your starting point. You know how they say X marks the spot? Well, X is your start. That's where you start your count. The following period is 1 and then forward. 1, 2, 3, 4, 5. Actually extended into 6 before it turned up. We'd also, look where we are on terms of RSI value, we're down near the 30 level. So on this chart, line A, connecting point X through number 6, and then your lower chart shows that the prices were continuing to go lower, but the RSI was not going lower. So bullish divergence, which normally comes in the downtrends. The 2 to 5s that we talk about, in this case with chart 233, extended to 6 periods before it turned up. But this was also a time, if you remember, I think this is a silver chart, when we were looking at that gold chart earlier with the range rules and seeing the gold had only come back to the 40 level. On this case, this divergence set up at around the 30 level in the RSI, but it was about the time that we were seeing gold down around the 40. Seeing that range rule that gold may be going into an uptrend. Your divergences, when they show up, should alert you to the fact, number one, that the market is a little overextended. Okay? This is a little overextended to the downside. We should get a bounce. If you're short because you had been in a 60-20 range and had seen bottom-top resistance, you might want to take profits. Take partial profits when you see bearish divergence if you're short. If you're in an uptrend and you see bullish, when you're in a downtrend, you see this bullish divergence, you want to take partial profits. If you're in an uptrend, you see it creating bearish divergence, like we did on that other chart, you might want to take partial profits on your long positions. But the bullish divergence usually comes in a downtrend. So as long as you're seeing your 60-20 range rule in effect and you're seeing bullish divergence, it's more input for the fact that the trend is still down. But the divergence is signifying that the market's a little oversold, is a little bit too low, and you might want to take some of your profits. Your next one, 234, was just a chart I had put in to show an example of the 2 period and what it would look like. Top chart, your bear divergence, the bottom chart, your bullish divergence. 35 would give you an example of what could be maybe a 3 period signal in your top pattern. 3 period bear. The middle pattern shows what a 4 period may look like. Now, these are RSI values that we're just counting on. And that 5 period at the bottom, it might have gone down for 3 periods and then come up for 2. $236 shows your bullish divergence with examples of a 3 period signal, a 4 period signal, and a 5-period signal. Now you can get variations. These are simple, straightforwards as far as patterns. Very simple. They're not very complex where there's an up and a down. We'll get into examples. I can show you complex patterns and hidden signals and everything else, but I want you to understand the signal count is probably the most important because of the fact that you will get divergences. You will get bearish divergences in uptrends. I continue to come back and just try and drive certain points in them, so when we get with charts with prices marked on them, and we can say, here's a 2-period bullish divergence. Bullish divergence comes in a downtrend. We should be watching for the 60-20 rules to hang in. When we bring in moving averages, we will show how moving averages can be applied to RSI to smooth volatility, but where the rallies and the pullbacks are in the RSI, whether they're above or below the moving averages. But the signal count is very important because I've been using it since 1978, and like I said, the 2 to 5 period signals, you'll get different variations. These are simple patterns. But these 2 to 5 period signals are ones which should alert you to the fact that the thing could change direction. If it's a bullish divergence and you're short, look to take partial, if not all of your profits. Again, incorporating your range rules, the price rules we had talked about, the price cycles. Now we're going to be going to new lows if we're making bullish divergence counts. The market is dropping to a new X point. So we go to our last high and take the difference between that high and this low. And we'll get the charts and show you how to do that. But when you're seeing divergence, realize that it's just an overextension, and as I said, a detour. My word is detour, because it's a detour from the primary trend. It's a little setback. If the market has been selling off, we get a little bullish divergence, it's a little overextended to the downside, a little oversold, and should rally back up and then go lower. So that rally is somewhat of a detour. So the divergence is setting the detour. Take your profits, let it fall again, stay with the trend. If it's a bear divergence, it's a little overextended to the upside.